cross-border banks have grown too big, too complex, too interconnected, and too international to fail. And the reasons for this are pretty obvious. Let me first cite the respectable one, which I hear whenever I talk about this subject, which is economies of scale and scope. Yes, right? Economies of scale in any activity are exhausted well before the 100 billion mark, even in retail banking. There's ample empirical evidence on that. Economies of scope, I will relabel these. Economies of scope are by and large economies of conflict of interest. The third reason that this incredible growth of banks that became too big, too complex, too interconnected, and too international to fail was monopoly power. Everybody likes monopoly power. Adam Smith recognized this. It's not unique to the financial sector. Another reason is, a very important one, is tax and regulatory arbitrage. And the last one, a very important one, is the strong desire, a rational desire to become too big and too whatever it is, too complex, too interconnected, and too international to fail, because that's where you want to be. Right? That's the free insurance. Now, we are seeing, I said, the repatriation of cross-border banking. I think branches of the conventional kind, no capital, no own liquidity, pooled liquidity, managed from headquarters, cross-border branches are going to be gone. No more iSafes. Right? So that means that the European passport, right? The home country, the mutual recognition principle, there's a home country supervision and regulation of branches. It doesn't work in finance. It works for plumbers, great, not in finance. Right? The pain is local in the host country, so regulation supervision will be in the host country. And that's where the governments and indeed banks will not stand behind foreign subsidiaries. They are the responsibility of the host country, fiscally as well. So that will become very clear. This repatriation of cross-border banking, I think, which is inevitable unless we suddenly have a wave of political and regulatory internationalization of the likes we haven't seen before, and which I don't anticipate, are bad news for London, of course, because this is the home of cross-border banking. Okay, fine, yes. So what lessons are people drawing from the need, I think the urgent need, to counter both the old Darwinism of the financial sector, becoming too fat and too interconnected to fail, and the new Darwinism that's to become too politically connected to fail? I think we're going to see serious consideration of proposals for a tax on bank size, say capital requirements increasing in the size of the balance sheet, never mind the leverage or any measure of risk. Gary Becker has proposed this, so both left and right of center people are looking at this. And all over the world we see this greater concentration in the banking sector, which is partly, of course, responsible for the profits we now see. But this is here, from a long-term consumer and efficiency point of view, disastrous. We have to go against it. I think we will have pressures, I don't know how strict it will be, towards narrow banking of the traditional kind, separation, if you want, of traditional high street banking and investment banking, but also a further unbundling of big banks to avoid manifest conflict of interest which are present in so many banks today. Adair Turner has, Alistair Adair, it's all the same, isn't it? Yeah. Adair has said, as regards the banking sector in Europe, we either have too much Europe or too little. And I think he's absolutely right. Right? I said we have too much Europe because it permits the host country, the home country regulation of foreign branches when there is no uniformity of standards or practices within the European Economic Area. So far too much Europe there. Too little, because if we had a single European regulator and supervision or common standards enforced in a homogeneous way, then we could have proper cross-border banking in Europe. The regulation proposed at the EU level by the La Rosière Committee is extremely, I think, pathetically modest. Colleges with possibly the power to set rules, Is it by qualified majority? Well, I would make it simple majority. And to monitor and enforce compliance is the minimum we need to keep cross-border banking in Europe. Otherwise, we only have, separately capitalized, arm's length subsidiaries, cross-border subsidiaries, independent liquidity, regulated, supervised locally with all the financial liquidity and solvency support provided by the host country. So total host country management, which takes away many of the reasons for having cross-border banking in the first place. Okay, we're going to, I think there's a general recognition that we have to regulate risk and risk-taking activities, not institutions, that's clear. And I think the attempts to regulate what they call hedge funds and the alternative investment market, while they may be wrong in detail, certainly point to the right principle that you go after highly leveraged activities. Regulation, I think, ultimately will have to match the domain of the market. Either regulation will expand to encompass the current market or the market will shrink. This will be reinforced, I think, by the end of tax havens, regulatory havens as we know it. It won't quite be the end, but there is for the first time, I think, in as long as I can remember, as long as I've been in this game, a real worldwide political will to close down most of the bank secrecy based forms of tax arbitrage and regulatory arbitrage. London as a financial sector is going to have, I think, a very hard time of it. London has been a regulatory haven for decades, right? We had, it competed not just on its genius and its great infrastructure, but also on tax dodgers and regulatory dodgers. London is the home of self-regulation and soft touch regulation, also known as light touch regulation. And with Adair, I think this is likely to end, but it became a destabilizing factor, not just here, but for the world as a whole. Regulatory capture, I think, and government capture by the financial sector is partly responsible for this. The new Labour was blinded by the light of the city and believed everything the city told it, and we're cleaning up the mess now. Well, 1 second. Okay, 1 minute, fine. We will, I think, see at least the de la Rogère proposals for European regulation implemented. And I hope that in due course, and not too far in the future, we'll move to a true European regulator and supervisor for border crossing banks and other systemically important financial institutions. What London can do, well, it can improve its infrastructure, its education, and its housing. Right? Don't lobby for retention of tax dodgers and regulatory sleight of hand that permit you to undercut global attempts to tighten down on the worst excesses of border crossing tax and regulatory arbitrage. Financial services in the city grew in the UK from 5.5% of GDP in '96 to about 10.8% in 2007. I think it will probably go back in a steady state to something halfway there, around the 7.5%. That's a big adjustment. But if you feel bad about that, just think of Ireland, which had 21% of its labor force in construction. Or Spain, which had 18% of GDP in construction activity, which have to go down to about 5%. Now, we are, I think this is unfortunate, before we get to a period of sensible tripartite regulation, first at the European level and in certain activities also the global level, we're going to go through a period of global over-regulation. There's no doubt about it. The body politic will have its pound of flesh. And it's happening now. But hopefully, after 5 to 10 years of over-regulation, we will get back to a sensible period of proper regulation, which would also benefit the City of London and allow it to compete on its competitive advantage rather than on its regulatory advantage. Thank you.